Preparing to. Hello, everybody. It's high noon, Rocky Mountain High time, and it's Eric with Weekly Tax Talk. We're hopeful that we're kind of ironing out some of the technological hiccups and burps and things that go on with this. So, first things first is we are discovering that. Okay, now I'm starting to do it again already here. I want to. Okay, I'm going to open comments here. Okay, and comment, hello everyone. And hit go. Now, I'm hopeful that if somebody else comments, and we've got somebody that actually will try that for me, and if you would please. My producer's on set here, sitting to the right. So this is intended to be a weekly check-in. During tax season, I just thought it might not be a bad idea. I actually worked for a major nationwide franchise, a tax preparation firm, one of the two that you think of when you think that sort of thing, the two that advertise on television back in January. So I was working for one of them, and our regional manager actually was going on the local TV station. And I think, in fact, he was doing it on Saturdays. So I kind of just crossed my mind, I could just jump on Facebook Live. I'm not too shy. I'm a little weird about it sometimes, but I've been dancing and cavorting around in front of people with an electric or bass guitar for decades. And for that reason, I don't really have much stage fright. And I thought we'd just sit and talk. So one of two things is going to happen. Either somebody's going to comment here and let me know this thing is working. Anybody? class. So if we get somebody to comment and test to make sure that questions can in fact actually come in. I'm asking my producer again here. So the two topics that I put into this is my very favorite subject, which is saving thousands of dollars on taxes. Now, there's two ways that I approach doing that, okay? Anybody that does a tax return for you basically should have a rudimentary knowledge of, okay, so you're coming up here. I'm sorry, we've got a comment, but it's not popping up over on this side. So that's supposed to show up on my phone. Sorry, hang in there with me, guys, just for a second. I want to make sure this is working. So, I think we're just going to work this way. So, see, it's there like that. Okay. I am able to see your questions. If somebody pops into the comments and types something, my producer is actually my wife, Barb Max Owings. If you're on that comment string, type a question in there, please. I've put this out to a couple of the biggest and best groups that I happen to be in on Facebook, and kind of hoping that, we've got 3 weeks to go until the new deadline, which is May 17th. And, all kinds of questions come up. People email me, send me direct messages, that kind of thing. I thought we'd just address a few things for a wider audience. So let me get back into some kind of flow here. The two ways in which I think that I'm able to save thousands of dollars in taxes. One is by basically drilling into your situation and making sure that you're writing off everything that you can. What you pay in tax on your business income is simply a function of the money that you make minus the ordinary and necessary expenses you get to subtract from that gross income to arrive at net income. Now, there are other things that go into taxes, of course. If you play around with stocks, and I know a lot of people that have, because there was a big dip last year when COVID first hit, the S&P and the Dow and everybody, I wouldn't say crashed, but it took a huge correction, went way down, and it was a good time to buy in. I certainly jumped on the bandwagon, and I'm not regretful that I did. And because of that, I'm seeing a lot of Schedule D, Schedule 89, Form 8949 entries. Whenever you sell a stock, you basically create a taxable event. If you've hung on to it for less than a year, it's going to be taxed at ordinary income tax rates, but of course, that is just on the amount that you made over what you paid for it. Say you bought, oh, I don't know what's a good one, Apple, okay, and you bought in it. I don't even know what it costs right now. Let's say you bought it for $200, and then it surged and it was at $250 at the time that you sold it. So that $200 purchase is what's known as a cost basis. You only pay tax on the $50 you made, of course, not the whole thing. So, I mean, that sounds like a no duh, but a lot of people don't understand that. And, I'm willing to share little tidbits of information like that. You only pay on the gain when you sell something. If you hang on to it for over a year, then you get the favorable capital gains rates. So that's 366 days, okay, a year and a day. All right, so one of the ways that we save our clients money to the best of our ability is to know as much as possible about the taxpayer situation and write things down to the best of our ability by asking questions and finding out what's going on. Often I'll pick up a new client and they'll have certain things on there, but I get to thinking about it 6 months later and wonder, why am I paying so much tax? Did this get done right? And it can be just a simple matter of doing a good taxpayer interview. So that's one way. And the other way is the S corporation election. And this is something I want to talk about all the time. You see it on my feed all the time. S corp basically allows you the ability to be your own officer employee of your 1 or 2 person company and take an ordinary wage. Excuse me, I'm going to call that a reasonable compensation, actually. And you will pay Social Security and Medicare on that compensation. The remainder of your income, net income, can be taken out as distributions later, but you don't pay Social Security and Medicare on that. And that's where the tax savings in S corp comes in. So those are the 2 things that we do. And if there's any questions on that, I'm kind of hoping somebody will ask one. I'm looking and nothing's popping in yet. So I'm going to go ahead and take a sip of my coffee real quick here. Excuse me. That's very good. Love Saturday coffee. So the other thing that I popped on about talking about was depreciation. There's a lot of confusion and a lot of head scratching over this. The basic concept behind it is when you buy a fixed asset, and that's something that you intend to use over a period of more than a year, you can actually expense the value of that asset over time. I'll do a few common examples. A vehicle is a 5-year life asset. Now, vehicles are kind of fun because there are bonus depreciation things set up from the Tax Cuts and Jobs Act that went into place in 2018. And last year, which we're still doing taxes for, by the way, tax year 2020 is the season that we're in now. Bonus depreciation hung around. So if you have been doing the mileage method, let me back up a little bit. So there are 2 different ways you can write off a car, either standard mileage or actual expense. And those things should have like a proper noun status for you, capitalized. Standard mileage or actual expense. Standard mileage is simple. You take the number of business miles that you drove through the year. You must have written evidence of it, some kind of a log, and you multiply that by the standard rate. In 2020, that's 57.5 cents. It's going down to 56 cents in 2021. I don't know where they come up with this, but I'm sure there's a reason, and I don't need to know it. So, but that kind of fluctuates up and down. It doesn't really match inflation. Thing is that there's things such as depreciation, maintenance, wear and tear, as well as gas and all that stuff is baked into that per mile amount. So now actual expense is when you are basically writing off what you actually spend on the vehicle. But when you do actual expense method, you also get to depreciate it. Depreciation is, once again, built into standard mileage, so you can't double dip and do it, take depreciation on the standard mileage method. If you get caught in an audit, you're going to pay the extra tax on that, plus interest and penalties. So don't do it. Okay. You are able to write off depreciation as well as all the actual expenses of your vehicle. Now it all comes into play. So that's the insurance that you pay, vehicle registration, taxes, license, tires, oil, parking, tolls, all of it. Okay. So either if you take standard mileage, you got to track your mileage. These days with smartphones, it's actually really super simple. I'm not going to quote unquote sponsor anybody by stating any one particular mileage app, but there's a couple of really good ones out there, as well as QuickBooks Online actually has one of their own if you have that. So I mentioned them because they are the accounting system of choice that we use for our customers. So, excuse me. So standard mileage isn't that hard to do going forward. If you're thinking about doing it and you haven't yet, I would get one of those apps and do it today. Usually, like Tinder, you can swipe one way for personal, the other for business, and it creates a really nice spreadsheet for your accountant at the end of the year. So actual expense, just a matter of keeping your receipts, logging things down. It's not a bad idea to write things down in a spreadsheet. You know your accountant doesn't want your actual paper receipts. If you bring those to me and actually ask me to create a tax return out of that, I'm sorry, but we have to charge extra because we don't want your receipts, but you do need to keep them in the unlikely event of an audit. Okay, so bouncing around a little bit on subject here. I want to get back to cars. So if you are in your first year of business, you must use the standard mileage method. Okay, you must use the standard mileage method. But if you started your business in November of 2019, okay, and you bought a car in 2020, we should talk, because if you made quite a bit of money and you didn't really tax plan the way you feel like you should have, paid enough estimated tax in, we can reduce your taxes dramatically by writing a lot of that vehicle off in the first year you purchased it. So I'm kind of hopeful that I didn't get too far off track with depreciation. It's basically the method of expensing a fixed asset over a period of more than 1 year. We'll talk about some of the more fun ones. Furniture is 7 years. Now, for my realtor people, especially my real estate investors, there are some certain things. Roofs. If you do a new roof on rental real estate, that's actually a 15-year. The rental real estate itself, when you purchase that and you are using it 100% for business, you have tenants in it, that's 27.5%. But if you purchase commercial real estate, you know, what they call a brick and mortar business, that's 39 years. So I think I said 27.5%. I meant 27.5 years. I'm sorry. That rental real estate is 27.5 years. And the way that works, by the way, is you basically write off the half year, the first year you own it. And then from that, it's a division problem, and it's always the same amount every year. That's why I think if you have the wherewithal and the kind of patience to be a landlord, and you're thinking about investing in real estate, I really enjoy helping people out with that, because there's so many different expenses with which you can reduce your gross income from that. Besides that, you got the mortgage interest. And I'm going to touch on that real quick, actually, and then I'm going to turn it over to questions or quit, one or the other. But we're about to wrap up here. One of the things I see when I do get expense sheets from rental real estate folks is that they write down the amount of the mortgage that they pay, and they basically net the money that they make after that. And I understand that. So let's say you're renting somebody a single family home, and it's $2,000 a month. That might be cheap these days. I don't know. But the mortgage payment you got on that's like $1,200. And what they do on their spreadsheet to see how much money they're making is they subtract the $1,200. Well, when I do your taxes, that's a no-no. The payments that you make on your mortgage are actually split payments, and they go to two different places. One is reducing a long-term liability, your loan. But the other part, interest, is actually a legitimate expense of your business and does reduce your gross income. So when you come to your tax guy, if you've got the amortization table from your closing, it's really super helpful to have that. So also, I would advise you, if you've got this kind of mindset, to maybe start writing that down on the spreadsheet that you're doing that way. So you're actually reducing your loan, so the payments are benefiting you on both sides. One, you're reducing your loan, and subsequently also reduce the amount of interest you pay each month. So that's a good thing. And the interest you're paying is also a good thing because you're reducing your gross income by it. So I would track both. If you feel like that's something that you can do. You, again, should have an amortization schedule from your loan company. And if you don't, I'm certain they can provide you one if you ask them for it. So with that, I'm going to look at the questions, and I'm not getting anything, so I must have been really crystal clear today. And I'm grateful for that. We're doing this every week, and I'm calling it High Noon Rocky Mountain High Time every Saturday. It's just the best time for our business to be able to pop on and say hello to everybody. And maybe you're having lunch and you want to watch the funny man talk about his favorite subject. If you've got your questions, tell your friends, please come join us next week. We're looking forward to seeing you then. So until then, so long and have a great week and enjoy the spring-like weather, okay? Bye for now.